Kevin, we got a big day tomorrow, of course. We've been waiting for it for months. Market expects Jay Powell to give us at least one cut. What do you think the chances are that he also delivers the language that bulls want to hear about what comes next?
Oh, I think he's learned his lesson after December, where it was all about guidance and managing the message. I think he's going to try to keep the market in line, but also he's coming up against some tough economic numbers that are not going in their way to be really dovish, right? If we look at this morning's report on the PCE, we can even see that inflation is back. And so, or not back, but, relatively speaking, where everyone's like, there's no inflation. So I think it's going to be a really hard time, come the fall, because I think the market is anticipating another cut in September, and I don't think he's going to give the market that absolute guidance where they can bake in 100% certainty on a September rate cut.
So where do you want to be in the market, Kevin, if you don't think that Powell can live up to the fullest of expectations? Do you want to be bearishly positioned or just capture a little vol in the short term? How big a deal is it if he comes out and he says one and done?
Yeah, I think everybody needs to be very conscientious of their high beta exposure. And we're starting to see actually in the options market, a lot more people are starting to hedge, and they're hedging out longer term. So if you look at the 3-month curve of the VIX, you can see that actually everybody's anticipating sort of some turbulence coming into the market. And that's actually, a seasonal effect, right? We've seen actually a lot of volatility come back September, October, August of 2015, we saw a lot of turbulence come into the market. Actually, we saw VIX spiked so much that the CBOE couldn't even calculate it on that Monday, August 24th. And guess what was happening? Everybody was talking about the Fed, and they were talking about China. Does it sound familiar? I think so. So I think it'd be a great time to start putting on some hedges.
All right. Now, for the rate conversation, because I want to talk a little bit about some of the REITs, some of the exposure you guys have in the funds that you run at Benchmark. What does this mean? If Powell doesn't follow through to that degree, do you see bond yields going upwards? Or is this actually a market that's going to be concerned that we don't have enough cuts to prevent recession and keep buying bonds? I mean, this is kind of the big question.
Yeah, I think you're actually seeing pressure to buying bonds, especially when you look around the globe. Everybody loves talking about Greece being at 2%, right? And then you've got negative yields elsewhere, and you're actually seeing potential recession over in Germany. Europe's having a very hard time. Brexit is still weighing on the UK economy. I mean, listen, they're having, negotiations with Scotland now about not having another independence referendum. So, I think there's a bid to the U.S. markets, that flight to safety. I think it is really going to do really well for the REIT market. Some of the high growth names in the REIT space we like to look at have done exceptionally well. I like to say an earnings trifecta. So, for example, Prologis beat on the top line, beat on the bottom line, raised guidance. So they're the industrial warehouses that get you a package in a day or less. So they announced their earnings, and then all of a sudden Amazon came out and said, listen, one-day shipping is a shock to the system. We need to reinvest more in that. Good for Prologis. Then you go into some of the other names that have reported, more importantly, Crown Castle, right? They're really the build out of 5G. They had an earnings trifecta as well. They beat on the top line, they beat on the bottom line, and they raised guidance. So I think those are great refuge. Because they've got secular growth behind them.
Yeah. We're looking at CCI right now. Last night we had SBCA report, SBA Communications rather, SBAC, which has been just rallying nonstop. Do you need this sort of continuing drumbeat of bond buying to keep the lift under these oaks? I imagine in addition to the thematic story, you've got a big rate and yield play that's taking place in some of these stocks as well.
Yeah, that's such a great point, because they do have a higher yield, especially compared to the S&P 500. And so we've seen that if rates do tick up, in the short term, they will be hit. And we saw that type of volatility and sell-off over previous rate hikes, right? When everybody was anticipating that rates were rising. But the important thing is rising rents matter more than rising rates, because AT&T, Verizon, Sprint, T-Mobile now is one, are going to spend as much money as humanly possible to make sure that you're going to their network for 5G. So they have to constantly reinvest in CapEx. And so the biggest overhang for these type of names is actually local and state municipalities that aren't issuing enough easements, entitlements, permitting, construction permits. So there's been a delay and backlog where they've had to push out the timetables to do a lot of the construction. So I don't think 5G is actually going to be here on a nationwide status as early as we think, because state and local municipalities are overburdened by the applications for the build out.
One of your guys' funds, SRVR, Kevin, has been a beneficiary of a lot of the stuff you're talking about. What do you see in terms of the actual additional either properties that can be accumulated or built? Like, what's the actual addressable market as we talk more server farms, more data and logistics warehouses? Where does the additional cash flow come from? Does it come from jacking up those rents in the existing places, or does it come from actually building out new locations and buying new locations and turning them into these places?
It's really the new location aspect. And actually, I'll give you a perfect example. So the vice president of technology for Qualcomm said, hey, listen, in our 4G LTE world right now, you look at a cell phone tower out there, they have about 3 to 15 antennas. In order for 5G world to work, right, where we're sending so much data and information and the packets are so strong, we're going to need 128 antennas per pole. Well, that just drops to the bottom line for an American Tower, which is actually going to be releasing earnings, for a Crown Castle, for an SBAC. So all they do is just lease out more space on their towers. Another thing they actually have to do is actually the build out of fiber networks underneath and for the connect ups. So it's actually the build out of these small nodes, putting more antennas on there. But one of the interesting aspects is we're actually going to need to build more data centers, because data is the new electricity, right? So think about, you've got artificial intelligence and machine learning is happening in all these cloud data centers. 95% of all compute power is done by the cloud. Think about Amazon, think about Microsoft, think about Google. They're building out these hyperscale data centers for that purpose. One of our largest constituents is Equinix, right? They just announced a $1 billion deal with the sovereign wealth fund to build out 6 hyperscale data centers over the next few years. So we've got to build this out if our economy is going to grow and become more digital.
Kevin, I want to kind of take this and go to a related point, but about the actual software companies and the cloud-centric names, because the more these products are used and the more they sell, obviously the more data centers that need to be powering this entire ecosystem. Yesterday, this whole group kind of got roughed up a little bit. There was a Barron's article over the weekend, but I mean, since when does the market care about valuations in these software names? Should we be concerned as they start reporting earnings over the next couple weeks?
Yeah, I think it's going to be pretty telling what happens when the managements come on and they actually address what was talked about in the article. And what was talked about in the article was really the stock-based compensation aspect. And so the market doesn't really look at that aspect when they report their earnings, but it is a giant component, right? So especially when they're looking at cash flow metrics, when they're looking at their earnings metrics, they're ignoring stock-based compensation. And when you actually factor that in, these companies aren't earning as much as the market thinks. And so when does that matter? That matters when market starts to hit turbulence, right? That matters where you just can't throw money at software and just expect it to work, right? Especially in your investment portfolios. So there are critical names like Twilio. I've been a shareholder in the past. I like it. It's one of the communications architecture on the software side, right? So when you order an Uber and you're actually texting with your Uber driver or talking to him, you're doing that through Twilio's communications architecture. Right. But at what point do you not buy that, right? At what point does it become too expensive? And so if people are going to start to focus on the stock-based compensation, it will. And yesterday it impacted the stock. So let's see what management say about that.
When this trade does, hit a wall because it's been so consistent, I mean, is it watch out below? Do you see a potential event where these software names have deep corrections around earnings if they don't hit properly? Because like every other group of this market that at one point was frothy has gone through a correction, and a deep one. FANG, Tesla, software is like the last, one standing here.
Yeah. I think what you will see will be a knock-on effect, and we've actually seen it in some other tech sectors, most notably semis, right? So semis tend to trade in a group, even though they're not all cut from the same cloth, right? So, NVIDIA with their GPUs versus, some other company with their CPUs. So the problem will be there will be a knock-on effect because no one knows where the bottom is. We haven't been through this before where software has really taken a correction. So nobody's going to want to have that risk on. So you'll start to see actually the whole sector will trade down. And we've seen reverberations of this happen before over the past several years when Tableau has, traded down off of earnings. The entire space got taken down. I think that was a couple years ago. But, nobody knows where the bottom is. And guess what? Then they take risk off.